trend following is starting to get more popular again, and there's certainly misconceptions that surround it. Can you talk about what it means to you, what it might mean to other people, and then how do you teach and explain it to financial advisors?
Yeah, this is the most difficult subject because teaching it in, let's say, an academic setting where I educate you on what trend following is, which I'll do here in a second, versus teaching an advisor how to stick with it when it doesn't work, because by definition, it's not going to work, is two vastly different things. That is my biggest challenge. And it's also, my biggest source of excitement and kind of a mission, if you will, is I really do think it's one of the best ways to manage money, hands down, especially for an advisor, but it's very difficult for a retail client to absorb. And it's very difficult for an advisor when they've got the emotional response of their client who they love and care for. And then they've got the same emotional response because they're watching the market and it's not doing what they want it to do, right? Because they're so outcome biased. And then they have a double whammy. So the advisor ends up having this double whammy of emotion, and that often creates bad behavior. So the key is really that educational component. So the way I define trend following is buying what's strong. So when prices are moving up, I want to be long with that. And when prices are moving down, I want to be out of that or short of that in a pure state. But in an advisory landscape, I always say out of that. I don't think an advisor should be actively shorting. They should hire a manager for that. But when you're looking at, so how would I define going up, going down? It's very simple. Higher highs and higher lows. Moving from the bottom left of the screen to the top right, that's an uptrend. And lower highs and lower lows is a negative trend. There's several ways you can define it. One of the easiest, I think, is like the 200-day moving average. Moving averages are robust, meaning I can go from 50-day to 60-day, 70-day, 80-day, 100-day, 200-day, 300-day, and they all do the same thing to the distribution of returns. They cut out the big left tails, right? The big negative events, and you compound it about the rate of return of the market, right? You don't get all the upside and none of the down like most clients and advisors want, but you do cut off those big negative events. And I think that's very helpful to a portfolio for at least a portion.